Hi all, I am Sham and I have Kishan with me.
Hi. Hi,
Wel-
everyone.
Welcome to Free Float. This is going to be an exciting episode. We are going to be talking about quality as a factor. So I think Kishan should
Yeah.
start this off, explaining what it is and how high quality stocks can be screened for and invested in.
Yeah. So you know that I mean, equality for me makes the most rational. It's the most rational factor because it makes intuitive sense, right? I mean, higher quality companies should get should trade higher than should trade higher than low quality companies. I mean, that makes sense to almost everyone. You know, even with no knowledge of investing, but if you tell them that there are two companies, one is a better quality, better managed company than the other, he would say, yeah, I mean, the one which is better managed should get a much higher valuation. Uh, so it makes rational sense to most people. Um, and my favorite example here is, say, the private sector banks. You have Kotak and HDFC Bank, which get traded. At I mean, they were trading 5 times book, 6 times book, but they've come down to 3.5, 4 times book. But if you compare them to other private sector banks, they have other private sector banks like ICCI and Federal Bank, Anderson trade probably one and a half times, or sometimes even less than one. And it all comes down to you can say we say that it's come down to return on assets, because this that one number shows you all the decisions that the management makes when it comes to banking. When it's come, what's the spread of interest, versus what you're borrowing and lending at, your bad asset, because if you're more bad assets, they don't earn any interest, right? And all those things, decisions. But also, it's also my thing that the market rewards companies where it has more trust, in the management or in the.
Yeah, but see, my point is, if you look at JP Morgan, what do you think is the PB ratio of JP Morgan, world's biggest bank?
Probably like around one time book.
1.3, right?
Yeah,
And it's richly valued, right?
yeah,
At 1.3, and everybody is like, oh no, it's so expensive.
yeah,
And the same bunch of analysts, slap a buy rating on HDFC Bank and Kotak Bank.
yeah,
So while I agree that quality stocks should command a premium, I think I disagree on how high that premium should be, and there is such a thing as a I think when we discussed value investing, we spoke about value traps, which
yeah,
is by metrics it looks really cheap, but if
yeah,
you buy it and it goes kaboom. And so there is such a thing as a quality trap, which is overpaying for a quality stock,
yeah,
and
yeah.
you spend like 10 years and the stock doesn't go anywhere.
So I think one important factor here is, um, you might have a highly valued stock, right? And that stock, because it's well regarded and stuff, might not fall much. It might give you some protection, and especially if you look for dividend yield, but it's not enough for you to have for you to earn a decent return by just buying a stock which is not going anywhere. So the thing with Kotak and HDFC Bank, I think, is that they're also growing at a fast pace, right? I mean, HDFC Bank, like legendly grows at 20% year on year, no matter what, right? And so they're also growing at that pace. So if you get 20% and your valuation remains four and a half times consistently, or 4 times, then your stock will also go 20% year on year, and every 3 years or 3.5 years it will double. And and the thing is, I will always say that buying things in Indian quality, like there's such low number of quality companies, really, right? So the fact that there's so much money and all this money has to chase a few things. Because because you would not invest a large sum in a company where you don't think it's well run. And in India you have this, the, almost no one does it based on factor investing or systematic. It's all discretionary, right? So what you perceive to be highly valued and stuff, obviously there's some cognitive methods used, but it's also based on who you trust. And the people who you trust, you end up giving them a lot more money and stuff. And even stocks in India, like Asian Paints, uh, I mean, highly valued 55 times earnings like last year, and it's growing at at low single digits. Its net profit, but the stock has doubled. I mean, I think now it's become 70, 80 times earnings. So I don't know. I mean, in India, because there's only a lot of money chasing a few stocks. The thing gets skewed. And obviously, I don't know, I mean, I think in the next 10 years, these stocks will underperform. But
Yeah, I mean, for them to underperform, there has to be another asset class where money can flow into, right?
right.
So I think the biggest problem, at least so far, has been that it's a story of saving suppression. In my mind, clear and simple. So you have your risk-free savings rate, which is below inflation at this point, right? So your savings bank is giving you what, like 3%, whereas official inflation is at 5%.
Yeah.
So unless you agree to lock in your money for like 10 years, you can't get north of 5% anywhere, risk free. So given the situation,
Yeah.
people
So,
want to invest, they end up chasing equity returns or real estate. And
yeah.
real estate, given the state of real estate, the less said the better, I feel. It's like a whole different ball game. And so that leaves things like cryptocurrency, which was hot for a while. Everybody went after it, and then that went bust. So
Also, I think there's a difference between speculative assets and investing assets. So when and the difference I would say is that is a certainty of return. So when you're trying to speculate, there's a great degree of risk, right? But when you're investing with a much more higher personal probability of of um, of you of your earning positive return, right? So for me, when it comes down to these stocks right now, say Infosys or Asian Paints and stuff, um, because you see a very long visibility, very very long visibility for its earnings and for its uh, and then because of that, so you're happy with earning even a small dividend yield and with some return expectation, because at least that you don't have to, maybe it's more tax efficient, or because you have no other avenue, like if you're an international investor, you're okay with earning 200% dividend yield, say from Coca-Cola, um, rather than investing in something that pays you much lesser. So because the certainty with Coca-Cola is much more, I mean, it's much more than, say, say maybe a tech company, because you can foresee even to 20 years from now there'll be people, who might still be drinking Coke, globally still drinking Coke. So so I think that's a big factor, I mean, in today's world.
yeah, so when it comes to Coca-Cola, I'm not a bull there. So primarily because I have seen what has happened to milk consumption in the US, right? So I don't know if you follow. I mean, the US markets, like kind of the demographic shifts that happen there.
Yeah.
The best part about the US markets are that for a numbers guy, they have a lot of numbers, so you can
Yeah.
actually track dairy consumption, across different demographies, over a period of time and all that. And the theory is pretty stable. So how much, liquid can a person consume in a day, right? So it's a finite amount of liquid. You can't
Yeah.
drink more than 8 liters or something.
Yeah.
So what is the pie of that 8 liters? Right? So the fight is there. So every day, Coke, Pepsi, milk producers, then all these new age
Orange
guys like
juice. Yeah.
orange juice, and then oat milk, then
Liquor.
almond milk, and water, right?
Yeah.
Bottled water, right?
And liquor and beer.
Yeah. So so they're all fighting for that 8 liters, that you're consuming, and getting your point of view across, in all that noise is difficult. And one of the biggest people who got hurt by it was the dairy industry, because everybody moved away from drinking milk, and that was because they moved away from cereal and adding dairy products in their milk in general, and they moved towards idiotic things like almond milk and oat milk and all that. Partly driven by that whole vegan thing. So anyway, so my point is that nothing is really set in stone, right? So often what happens is, you get outflanked by someone who is coming from you sideways. Um, so Pepsi got outflanked by the whole natural thing, right? So it's not enough to make Tropicana, right? Orange
Yeah.
juice. That orange juice has to be fresh, and it has to be coming from some organic tree
Yeah.
and all that stuff, right? So even though it is just still orange juice, just the shift in consumer preference made
Yeah.
Tropicana
It's
irrelevant.
a big thing. Yeah. I mean,
Yeah.
yeah. So there is obviously. I mean, a lot of these companies do face that challenge, right? Especially Coke, because like sugar has become, the new tobacco. You
Yeah.
know, so in that way, yeah. I mean, obviously, these trends, uh, but the thing is that if I'm an investor allocating money, you're trying to find money to allocate to and earn a return of say 24%. And my choice is between Coca-Cola and versus I don't know. I mean, say
Tesla.
yeah. I mean, but yeah, I know, and it will be much more. I mean, especially if I'm managing a pension fund, I would rather put it in Coca-Cola because the volatility and stuff is much lesser. So I mean, I think we all have to look at it from that perspective that quality. Uh, because it's highly valued, I don't. No one should expect it to, like outperform, like in the bull market, or really go up a lot. But what you should expect is at least earn a decent return, which justifies you holding the stock. And I think getting a bargain sometimes, in a quality stock, it is possible that sometimes you might get lucky when like when you're Nestle, like
Right.
like a few years ago, which had that all the scandals and stuff, and went down to 7,000 and stuff, and if you just ignored the news and uh, bought it, then you would be sitting very pretty, very happy to sell. And that's what even Warren Buffett did. Um, he bought Coca-Cola I think, doing a particular scandal.
Okay.
I'm not sure. I think, but maybe that's just American Express. But the idea is that you buy you know these companies when they're beaten down. Obviously, in India, everyone seems to have bought ITC.
Well, I looked at the ITC chart, and it looks like for the last 7 years, including dividends and everything, it has not gone anywhere, right? So 7 years is a long time to wait for anything to kind of give you a return.
Yeah,
Uh,
and
and and
I think with ITC, the problem is right now. Um, um, right now it's no one is just excited about it, and and the thing is, um, um, it's out of favor, and if you're an investor who holds ITC, you know you have to, I mean, you'll be scratching your head out or like wondering what happened. But at the same time, isn't an alternative. I mean, because you compare ITC versus HUL and stuff, and you see the difference in in evaluation. So at some point, the management will do something, because even if they just unlock or demerge the companies from the tobacco and FMCG and hotels, I think it will unlock consumer value for the shareholder. You know.
Yeah. See, my point, I think I brought this up during our last free float as well, is that unless they spin off all the non-tobacco assets, it is not going to get unlocked, because that whole hospitality thing is a big drag,
Yeah.
and and that FMCG thing is it still requires at least one more decade of investing to make it sort of competitive. They had to compete with what, like, who's the competitor for ITC and FMCG, right? So Britannia, Parley, and those guys, and
HUL.
HUL. So they've been in this business for like decades now, and
Yes.
from a volume point of view, just to catch up, they still need, ITC still has a long road ahead of them. But having said that, respecting the process is important, right? So if you screen for quality and ITC shows up, you need to allocate to it, because ITC is going to rank pretty highly because of all the free
Yes.
cash flows and everything. Um, so that is one thing. The other thing is, what I saw was, when you screen for quality in India, and if you exclude financial services, most of it is going to be FMCG,
Yes.
right? So outside of FMCG, you will hardly find anything like no infra, right? And most of these screeners say that you should not run it on financial services,
Yeah.
right? So all your Bajaj Finance and HDFC and Kotak is probably not included in the universe itself.
Yeah. But
Uh,
then, I mean, what I like to do is actually remove all the financials into different, basket, and then run them on, on a similar metric.
right. So if you do all that, then you do end up with just the well-known names that we have. So where is the where is the alpha coming from? If you're going to invest in everything that everybody already knows, right?
Yeah. There's no fun in.
Yeah, I mean, look at some of the like, if you look at the balance sheet strength strategy, right? So you have like Abbott, Sera, Dabur, Eicher Motors, Godrej Consumer Products, ITC, Kansai Nerolac, Marico. I mean, these things, I don't know, where's the alpha in it?
Yeah.
Everybody knows that they are good stocks, so the alpha is probably with just you buying it and holding it for a long time. That's pretty much it. It's the time duration alpha. How
Yeah.
long can you hold?
Yeah. I think you're right about that.
So what else you got? You were talking about MSCI Quality. What is that about?
So so basically, you have all these factors, right? Like you said, and you have like backdated these factors, or run a historical test with these factors for much longer duration. And the thing about quality is that it does underperform value and momentum, uh, but also the volatility is much lesser. So you do have that safety in terms of the drawdowns being being lesser, but also then you have also the benefit of having decent returns. I mean, though it underperforms value momentum, it's not bad. It's not being it's not being bad returns. The question is, uh, uh, where does this all fit in your portfolio? I mean, so my thing is that buying a quality portfolio is like as I said, like a good time bet. That, these companies will outlast that competition. They are not. I mean, will outlast in terms of because it's a brand, and they'll endure. and just because of that, it makes me want to buy them. Like you won't find an airline company, for example. You'll find companies which have good control over most things that affect the business. They have a good brand value. Like Crystal is something that we mentioned, but Crystal has such a good brand value that most banks or most financial institutions want a Crystal rating. So
Right.
every person who's issuing debt wants a Crystal rating because it will make them look good. So they have this thing of brand power, which is intangible, right? Which is very, very hard to build because ICRA and CARE have been around for as long, and they also have good pedigree. But Crystal is has got has got 5 stars, and so all those things end up mattering in terms of even if your portfolio falls, you can sleep well at night. I think that's a big thing. If your momentum and we both run momentum portfolios, and when the tide turns, it goes really the other way. And if you don't implement your strategy, the way it is, like take stop loss and stuff, that strategy will will have disastrous impact. But quality, even if you just buy it and hold it, and uh, stuff goes wrong, the entire world goes on lockdown. No matter what happens, this portfolio would do better. Like it won't be, you won't be so worried.
Yeah. So tell me your thoughts on CDSL. That's one, it's one stock that I bought for my clients, during the lockdown. Basically, the bet was that, it's a duopoly business with
Yeah,
the NSDL and CDSL, but with
yeah,
CDSL having a huge chunk of the market.
yeah,
Every time you buy or you sell shares,
yeah.
right? CDSL
They
gets
get paid.
paid. Yeah.
Yeah,
So it's like basically a chapama business, right? So all you need is a freaking database. That's it. It's one glorified database, and they're the gatekeepers of the database. So it's just free money,
yeah,
because all you need to do is make sure that your database can handle flow, and that's it. And your profits are guaranteed by by the regulators.
yeah,
So
yeah. And so yeah, and right now there's been a boom in stock trading, right? The
I,
number of accounts open and stuff. So yeah, and it's expensive. I mean, you know,
Yeah,
uh,
that's exactly my point. So when I bought it, it was cheap, right? So it was around 30 or 40 p or something like that. Now it's like what, 80 p. So
yeah,
the question is, if somebody buys it at this valuation, it's a
yeah,
great quality business, right? It's got a moat, right? No new depository is going to come and take away its business.
yeah,
It's basically set for life, right? It's like a government. It's like buying a government department. It's
yeah,
like buying the taluk office of India or something like that. So it's great in every aspect except the current valuation. So you're always caught in this bind because the stocks kind of corrected by about 5% over the last week, and you're thinking, what if this is the beginning of a larger correction, and things kind of stabilize around 30 PE, so you lose around 20-30% of
yeah.
your
But
current.
except in India, the thing is, business like this are rare.
Yeah.
Yeah, like to find a business like this, which has very high certainty about the business, and the fact is no one else can come into it, so it will be CDSL and NSDL,
Yeah.
and no one else can enter the space, and high barriers of entry, uh, and the thing, and eventually the pricing will be with CDSL and NSDL, and so there's virtually nothing that can go wrong. I mean, in this particular stock. So that is the reason why people like, why like this, because I can say even 10 years from now, CDSL will be there, and it will grow perhaps 10-20%, 10-20%, but people are okay with that,
Yeah. You probably give out a big fat dividend as well. So
yeah, I mean, especially is it a PSU?
no, it's not.
It's
No.
not PSU. Okay.
Yeah.
Yeah, if it's a PSU, then you can you could have been sure that you'll get a big dividend.
Yeah, that is true. The government will probably raid it even before you see a
Every year.
sunset.
Yeah. I mean, every year before before you do anything, please pay us.
Yeah. But thankfully, no. It was actually owned by BSC. I mean, BSC was a big shareholder of CDSL, and before they listed themselves, they listed this. But anyway, it's one of these things. I mean, as easy as buying high quality companies sound, it's never easy because you can always see risks around the corner, and most of the time the biggest risk is valuation risk. um, so it's best to sort of put it in put it in an account where you can just drop it in and forget about it. um, that's probably the best way to go about quality investing, because everything else, yeah, you're going to look at the price way too often, and you're going to panic at some time, and you're going to exit and
Yeah.
feel sorry about it.
Yeah, I mean, I think the point is like if you want to buy and hold, buy and hold and forget portfolio, quality is a good place to be.
Right. All right, everyone. So that is quality investing for you, and thank you for tuning in to Free Float. We will catch you again next week.